Hey, what's up, guys? John here. I'm sitting here with George Gammon, economist, real estate investor, and entrepreneur, and we are going to talk about what's really going on in the economy. We're going to talk about central bank digital currencies. We're going to talk about the real estate market. We're going to talk about inflation. We're going to talk about what the media is not talking about. George has a really unique ability to break down some of these complex conversations, and that's what we're going to do here on the show. George, thanks for having me over.
Oh, thanks for being here, John.
Yeah.
It's a pleasure. Got the whole setup here. I feel like I'm already in studio, although it's the living room of one of my rental properties.
Yeah, thanks for having us over. Yeah,
in
we set
Medellin,
this up.
Colombia, of all places. Right?
Yeah, a beautiful place. Beautiful place. You remodeled this from scratch.
Yeah, well, we not only remodeled it, we pretty much gutted it. And, back in the States, we say we took it to the studs.
Yeah.
But here we don't have studs because it's all concrete and brick. So we basically took it to the concrete shell and then kind of built from a clean slate and turned out pretty well.
Yeah.
Good return on investment.
Yeah, it looks like a beautiful, beautiful property. What's it like doing a renovation in Colombia compared to like in the States? Is it easier or more complex?
There's more pitfalls. I think there's more opportunity, but there's definitely more pitfalls. And like I was just doing a story the other day on the United States and these Airbnbs, that people went out and bought in 2020 and 2021 just to kind of make ends meet.
Yep.
But they bought them knowing that if they had to rent them out long term, that they'd have negative cash flow because the mortgage or the rent wouldn't cover the mortgage and the insurance payments and maintenance and whatnot. But if they rent them out nightly, because you can get a higher rate, and assuming they've got an 80% occupancy rate, now all of a sudden they're cash flow positive and it can be this side hustle. And unfortunately, a lot of those people are realizing that the occupancy wasn't what they expected. And then some places like New York and Dallas are effectively banning Airbnbs with these new regulations. So people are stuck in a position where they've got to rent it out longer term and they're screwed. They're probably going to have to just sell those properties, which we could talk about later. But my point is I was doing some of the RV ratios there, and these people were lucky to get maybe a 0.5, meaning that if they buy a property for $1 million, they're lucky to get $5,000 a month in rent. Mm-hmm. And back when I first got into real estate in 2012, I would always look for 1% plus back then. So if you had a $100,000 property,
$1,000 a month,
you got it, $1,200 a month, and you could do that all day long in 2012. The good thing about Medellin, which is my point, is you can still do that. Like this property that we're in right now would probably sell for about $300,000 and maybe $50,000 US. Mm-hmm. But you could rent this out easily for $3,000 a month, maybe even $3,500. So even after you're buying a turnkey property without building that equity up front, you can still get that 1% RV ratio.
Why do you think that is? Do you think it's because obviously the incomes in Medellin obviously are not competitive with America, or do you think that we're going to ultimately see this arbitrage opportunity slowly start to fade away as America becomes much more challenged in the coming years?
So it's a great question. I do think there is a little bit of a maybe rental bubble, if you will, here in Medellin with the Airbnbs, and I think the rental market overall, because you've had so much purchasing power come down from the United States. It was kind of like a perfect storm because back in 2010, no gringos would come here because everyone was worried about getting kidnapped and all these things.
Yeah.
It probably weren't I'd say early 2000s, those concerns were justified. 2010, not really. Now, not even close. So, but with the advent of Instagram, now you have all the people come down here, they put it up on Instagram, everyone sees that it's a very safe place, but it's gorgeous. The weather, as you guys know, is perfect. The people are awesome. The food's incredible. The cost of living is very low. So people are coming down like, boy, what's not to like? So you've got more and more people coming down as a result of Instagram, that stigma kind of going away, while at the exact same time, people were loaded with stimulus checks, and especially that younger generation. They not only had an increase in purchasing power because their nominal wages were going up a lot faster than their inflation rate. I'd say overall, real wages declined. Mm-hmm. But if you're looking at just the 16 to, let's say, 24-year-olds or 30-year-olds that were still living at home, they're not really impacted so much by inflation, but yet their nominal wages are going up, and plus they don't have to pay their student loans. So you've got all this additional purchasing power with that demographic that really likes to travel.
Yeah.
And then you have all that pent up demand, and you have the whatever they're calling it. What are they calling it? Like anger traveling or revenge travel.
Yeah, revenge travel.
So I think it's kind of this perfect storm where Medellin was becoming very, very popular.
Yeah.
Even before the pandemic. And then you had all this revenge travel with all this pent up demand and additional purchasing power. So I do think that that's one reason why you're probably able to get a 1% RV ratio here easily, even with just buying a turnkey property, might not last because the rents have gone up so much faster than the actual value of the properties, although the properties have gone up significantly as well. But I see that kind of equaling out to where I think you'll still be able to get a 1% RV ratio here, but you'll have to put in a little work.
Yeah.
You're not going to be able to just buy something turnkey. You're going to have to buy something where you know that you'll have to come in and maybe not do a complete renovation like I did here, but at least fix up the kitchen, maybe redo the floors, just fix up the master bathroom, and then kind of stage it well and put a little effort, little elbow grease, and then you'll get that 1% return. I think that's kind of the equilibrium moving forward, but we'll see.
Today's video is sponsored by GreatCreditFast. Do you want to invest in real estate or possibly Airbnb? Maybe you want to start and grow a company or a business or possibly get debt free. With great credit, you're able to achieve all of this and much, much more. The last thing that you want to do is borrow money from a credit card company paying 25 or 27% interest, because when you look at the real numbers and you look at what's actually happening in the economy, that's the worst strategy and it's almost a guaranteed failure. Take a look at this. So if you're borrowing $10,000 at a 27% interest rate, paying $250 a month, it's going to take about 9 years to pay this off and about $16,000 in wasted resources paid to one of these credit card companies. However, with great credit, you're able to do a balance transfer in most cases and get debt free for 0% interest and pay this off in a fraction of the time. In 2008, banks started tightening up lending restrictions, and that's exactly what they are doing now. They're getting ready to tighten up lending restrictions, meaning that if you have that low credit score, 400, 500, 600 credit score, if you're in that even low 700s, it becomes much more challenging to get access to money. But if you look at Blackstone, for example, Blackstone, they are using their credit and their relationships to raise money. They've just raised $30 billion to invest in single-family rentals. If you want to invest in real estate, you want to really grow and scale during the greatest wealth transfer of all time, you're going to need great credit to do it. We would love to give you a free consultation to see how we can help you at GreatCreditFast.com. That's GreatCreditFast.com, or give us a call at 561-430-5900. Now back to the show.
The last time we hung out last month, you mentioned that it's a different experience buying a property in Medellin than in America, because it's not the MLS or Zillow. It's mainly you'll see a sign in the yard and then you see if you can engage in a price point that makes sense for both parties.
Yeah, that's right. It's just there's so much more opportunity here because the market is incredibly inefficient, but there's also a lot more pitfalls because first of all, if you're a gringo coming down here, you don't speak Spanish, and you go online to a website that is only in Spanish, and you're looking to have the same buying experience that you would have in the United States, you're going to overpay.
Yeah.
I guarantee you, you're going to overpay. But if you're someone that's willing to come down and do the boots on the ground research, even if you don't speak Spanish, but understand the neighborhoods kind of street by street, and then start looking at properties every single week, you start to get an idea of what the comps are. And once you truly understand what the comps are, because there is no MLS to determine that for you, you've actually got to use your brain instead of delegating that to a computer, right? But then once you kind of get that boots on the ground knowledge, then you can utilize that to your advantage to find a really good deal. And because there's very low liquidity in the market relative to the United States, meaning that it's a lot tougher to get a loan. A gringo, there's no way you're going to get a loan.
Yeah.
But even if you're a Colombian, you're going to get a loan at 15, 18%. You're going to need to come up with a 40% down payment. So because the liquidity is a lot lower here, it's harder to find a buyer, which is not good if you're the seller. But on the buy side, which is where you make all your money as a real estate investor anyway, that's a huge advantage because it's a lot easier to find motivated sellers. And when you find that motivated seller, that's when you can get $1 for 50 cents, which is pretty much my entire investment strategy. You see, most people, even in stocks or anything, where prices move up and down, any asset class, they tend to, in my opinion, make the mistake of trying to predict price direction. So as an example, if I'm looking at the share of Tesla, if I'm looking at oil stocks or the S&P 500 or something like that, or even the real estate market, they're trying to determine our price is going to go up or down. I think that's a fool's game. I think the only thing that you can truly determine is whether or not something is cheap or whether or not something's expensive. And if it's cheap, buy it. If it's expensive, just go ahead and sell it.
Yep.
Forget about the price direction, for heaven's sakes. I sold my last property in the United States in 2022. Now, you could sit there and say I sold too early. Well, did I? Maybe I missed out on a few gains, but I could care less because I'm not trying to time the bottom. I'm not trying to time the top.
Yep.
I'm just simply buying things in 2012 when they're cheap, and I'm selling them. I actually started selling in 2018. Started selling my rental property. And I never once thought, oh my gosh, if I would have held on to them longer, I could have had more of a capital appreciation. Because again, I'm not trying to time the top. I'm not trying to predict price direction, only trying to determine whether it's cheap or expensive. So anyway, I think to start with that type of mindset, you're out there trying to buy $1 for 50 cents because that's the only thing that you can truly predict or truly know. Where most people, I say they're buying $1 for $3, hoping that it goes to $5.
Yep.
And I don't play that game.
Yeah. So did you sit out a lot the last couple of years? Because it seems like everything was basically just that.
Oh, sure. And I could care less. And I think I've maybe have an edge because before I got into the world of investing, way back in the day, and when I first became an entrepreneur, I was really into blackjack. And, Beat the Dealer by Ed Thorpe. I was reading that. It's just absolutely fascinating to me how there could be a system to where you could win, or you could have the edge. You could be the house. And once I started to understood, you combine counting cards, the basic strategy, and all these things, that over the long run, if you do that, you're going to have a mathematical edge and you're guaranteed to win. So in blackjack, especially when you're first starting, you've got to train your brain to think in terms of probabilities and completely ignore outcomes. So as an example, most people after a night of blackjack would consider it a good night, so to speak, good night, if they won or lost money. I would never look at it that way. I would determine the success of the night not by how many chips I had, but whether or not I played each hand correctly based on the probabilities. And even if I lost money, I knew that if I played each hand correctly based on the probabilities, depending on the count of the deck, then that was a success for me because I knew if I did that long term, I would always win because I had a probabilistic edge, just like the house always does. That's the way blackjack works, right? So whenever someone tells me, oh, George, aren't you pissed off or whatever that you sold some of your properties in 2018 and you missed out on all those gains? I say, no, because that's very similar to going to play blackjack with one of your buddies. And you're out there having fun. Let's say you're out there and you've had a few drinks, you've had a couple shots of tequila, and you're just out there enjoying yourself. And let's say your buddy's on a hot streak, but he doesn't know about blackjack. He doesn't know about basic strategy. And let's just say for a moment that he has a 19. And you say, hey, buddy, that's a great hand. You always want to stay on a 19. And he says, oh, George, what do you know? You're always way too conservative. Just don't pay any. I'm on a hot streak. I'm going to go ahead and hit. Okay, you're going to hit on a 19.
Yeah.
He hits on the 19, and let's say he gets a 2, he gets blackjack.
Yep.
Okay, so did he do the right thing or the wrong thing? It depends on your perspective.
Right.
I would argue that he did the wrong thing. Even though he won, he did the wrong thing because if he does that over and over and over again, eventually he's going to go bust.
Yep.
Right? And so I think it's the exact same thing looking at the real estate market over the last couple of years. Did you miss out on all these gains? Sure. But that's just like if you missed out on potentially getting a blackjack by hitting on a 19, right? Over the long run, if you play by the odds, you're going to win. And that's just basically buying things when they're cheap selling them when they're expensive, and forgetting about price direction.
Yeah. So, obviously Sam Zell, in his book, Am I Being Too Subtle? He went and he discussed, he went out to college. He worked for a property management company. They had 600 doors or 700 doors. They were mainly just doing student housing.
Yeah.
And at that time, he was seeing the amount of money and potential that was in real estate, and he was in law school at the time. He did one day he finished, he graduated, he did one day as an attorney. He quit, and what he did was he raised money, and he held money for a single year, and he wouldn't buy until it made sense. The market ended up crashing. He ended up going out there, acquiring a lot of assets, and he developed a nickname, the Grave Dancer. Just being patient, waiting for the numbers and everything to make sense to come to him.
That's always the style of investing that made the most sense to me. Mm-hmm. And I don't know what came first, the chicken or the egg. And what I mean by that is when I first started to get into investing is when I retired in 2012. One of the first investors that I stumbled upon was Jim Rogers. And he's still to this day my favorite investor. And I don't know that he's my favorite because he was the first and that really shaped my thinking, or because his style of investing resonated with me to begin with, just because that's kind of my personality. But that's what Jim would do. In fact, the first time I even heard his name was he was interviewed in one of the Market Wizards books. Those just incredible, I think 3-book series from Jack Schwager. I think they started in the late 80s, I think his last one was in 2000 or something like that. But Jim was interviewed in that book, and he kept saying over and over and over again that he's not a trader, he's not a trader, he's not a trader. And one of the main takeaways from his interview was his strategy is basically he sits in a chair and does nothing. And he just waits. And he just waits until he sees a big pile of money sitting in the corner, and then he just goes over and picks it up.
Yeah.
And that's his investment strategy.
Yeah.
And you at the beginning here, you talked about me having a knack for taking the complex and putting it into very simple terms. But I think that the best person in history possibly to do that is Jim Rogers. And so that always made a lot of sense to me. And another thing that he said is people always feel the need that they have to be doing something. I've got to be doing something. And he says, no. He says, that's the quick way to the poorhouse, is how he described it. Being an OG guy from some little town in Alabama, I think. And I think one of the funny things he always says that when he was growing up, his town was so small that his phone number was 5. Just the number 5.
Yeah.
Because there were so few people that lived in his town. And maybe that's why he's got the gift to put things in very simple terms with that Southern draw. But my whole point is I looked at that and said, that makes a lot of sense. Just don't do anything. And especially now when you can just sit in T-bills and get 5.5%, for heaven's sakes. Just don't do anything. Just wait for the market to come to you. And, this may take us to another topic, but I think it's relevant that right now we've got this inversion of the curve. And probably 9 out of 10 times when you get an inverted curve, with the exception of the mid-1960s, you're going to have a recession.
Well, explain what the yield curve is and what it is in an inversion for people that know very, very little about finance.
Yes, sure. So it's you've got different maturities on the yield curve when we're looking at the treasury market. So you've got a 1-month treasury, you've got a 3-month treasury, you've got a 2-year treasury, you've got a 10-year treasury, and a 30-year. So obviously the maturity on the 30-year, let's say, is way out here, and the maturity on a 1-month is here. Well, if you think about it in terms of just you lending money to your buddy, if you lent him $1,000, you most likely would charge him a higher interest rate if he wanted to borrow that money for 5 years compared to 5 days.
Right.
Because you've got way more risk involved there. You've got inflation risk. Who knows what he's going to be doing in 5 years, if he's got a job, if he's going to be able to pay you back. So that's in a normal, healthy economy, you would see the interest rates at the shorter maturities much, much lower than you would at the longer maturities. Just makes sense. But when you have an inversion of the curve, it's this anomaly type situation where the interest rates actually at the front end of the curve are higher than they are at the long end of the curve. So as an example, right now as we speak, the 10-year treasury is about 4.2%. But the Fed funds rate, the overnight rate set by Jerome Powell, is around 5.25%. So it's 100 basis points over the 10-year Treasury. That tells you something is wrong. Something is really, really wrong. And that's why 9 out of 10 times when we get this inversion, we have a recession that follows. Usually once the curve inverts, you get a recession within 14, 18 months, something like that, or about 12 months since the curve inverted. The curve inverted, right off the top of my head, in October of 22. So assuming it's 14 months on average, that would peg it right around December of 2023, that we should expect kind of the stuff to hit the fan. And usually what happens, well, not usually, every single time, the way the curve steepens out, or uninverts, if you will, is by the Fed dropping the front end of the curve because of some sort of crisis situation, because they see the unemployment rate spiking, or the GFC would be a great example of that. They see the banking system imploding, and then they drop the front end of the curve, and then the 10-year goes down a bit, but doesn't go down as much as the Fed funds rate, and that's what steepens out that curve. They call that a bull steepener. And if you go back to 1950, which as long as I've seen data on the yield curve itself, every single time we've had an uninversion or a steepening of the curve, it's because of that bull steepener, which is significant, because that means that you hear this narrative right now that we're going to have no landing or soft landing or something like that. Well, in order to have that, you would have to have the rates at the long end of the curve go up above Fed funds. And most people say, oh, no, if we have a soft landing, well, the Fed's going to drop rates. Well, why would they? Because what that implies is the rates right now are historically high. No. We're not dealing with Paul Volcker here. The Fed funds is not at 18%. It's at 5, for heaven's sakes, 5.25. That's historically normal. So let's just assume that the inflation pressures subside in the eyes of Jerome Powell. Why would he drop rates? He wouldn't, because they're just historically normal. He'd leave them right about where they are now, right? So the argument there has to be that the long end of the curve would go up, and that's what would steepen out the curve. They call it a bear steepener, right? But we've never had that, John, in history. Once the yield curve inverts, it never, not even once, has uninverted as a result of that bear steepener, which for the economy would be very, very bullish. That would indicate that soft landing. By the bull steepener, the Fed dropping rates, which is what the market is predicting, that's very negative for the economy. And that's kind of the highest probability. So my whole point there was saying, look, right now we've got the inversion of the curve. And usually, in fact, every single time that I can remember, the recession doesn't happen until the Fed starts dropping rates, which steepens out the curve. So if you look at that inversion, it'll dip below zero, because what they do is they take the 10-year minus like the 3-month, let's say, the yields, right? Mm-hmm. So it'll go negative, and then what happens is it'll pop back up and go positive, and then you'll see that gray bar, that you always see on those Fred charts, that indicates the recession. So my point there is the recession always comes after the curve is no longer inverted, and that's a result of the Fed dropping rates because they see the stuff hitting the fan. So right now we're still inverted. We're still in kind of this holding pattern. But what the bond market is telling us is that there is extreme amounts of risk out there. And let's not forget that the most powerful macroeconomic indicator that we have is the yield curve, is the inversion. This is the most accurate. This has the highest predictive power of anything that I have ever seen. So why on earth would you, as any type of investor, wanting to take additional risk right now when, again, you could get 5.5% just sitting in a T-bill and just waiting to see how this plays out, just like Jim Rogers. Mm-hmm. Right now, there is no pile of money sitting in the corner.
Yep.
Right? We're in the everything bubble. Nothing is quote-unquote cheap relative to its historic price adjusted for inflation. I'm just using commodities as an example there, right? Mm-hmm. So if there's no pile of money sitting in the corner, and on top of that, we've got this red flag that's being waved right in front of you with the inversion of the curve, and you can get 5.5%. Why would you not just sit back and wait like Jim Rogers? And then when things get cheap, see how it plays out. Just wait. The curve's not going to be inverted forever, right? That's not an option. So just wait and see how it plays out. You're not going to have to wait long. Most likely, at the most, 6-9 months. But then when you do, you got all this dry powder to deploy and find out what's cheap at that. Is oil cheap? Is coal? I think commodities are going to be cheap. But maybe it's real estate. Maybe real estate gets cheap again. Maybe it's stocks. Maybe it's the S&P 500. Maybe it's the FANG stocks. Who knows? But at least you've got that powder that's paying you to wait until you see that big pile of money sitting in the corner. Bam, then you take action.
So historically, definitely, right? But the big question is the last 3 years, what we've seen is this game of musical chairs in the economy, in which they just keep pumping money. They keep doing everything that they possibly do to try to pause reality and try to stop what should be happening from happening. Do you think that in the event that we step into that situation, they're just going to print a ton of money and they're just going to try to do whatever they could possibly do to, it's not going to make any difference. It's probably going to make things worse. But what do you expect them to do, and how do you expect them to respond, given how they've responded over the last few years with everything?
The exact same way. But we're talking about two separate things there, right? So we've got to look at a timeline. It is true. When the stuff hits the fan, assuming that the yield curve is correct, they will likely respond the exact same way they responded in 2020 and the exact same way that they responded in 2008, but just more of that, right? Because it's like the monetary heroin, and that in order to get the same effect, you've got to do more and more and more of that monetary stimulus. Now, the money printing, that gets very technical and nuanced, so it's not as easy for them to quote unquote print money, but it is easy for the government in a crisis situation to come out and deficit spend. And so I think that they're going to have to deficit spend to a greater degree than they did in 2020. So if they had a $5 trillion CARES Act or whatever, this time to really move the needle, who knows? It's going to 7-10 trillion, something like that. And that probably takes us to that next wave of consumer price inflation. But between now and then, I think that's when you get a disinflationary or maybe even a deflationary type of crash. Because we have to remember that the government and the Federal Reserve, the central planners, the authoritarians, they're always going to be reactionary. They're not that bright. So they aren't going to take preventative measures. If the unemployment rate, as an example, is still at sub 4, even though the yield curve is screaming at them, they're not going to pause interest rate hikes. They're not going to come out with more QE. They're not going to come out with, although they're deficit spending right now to a massive degree, but they're not going to come out with the CARES Act 2.0 when the unemployment rate's still at 3.8, right? They wait until it hits the fan and then they react. It's just like the Fed with Silicon Valley Bank, right? Look, why didn't the Fed see that? That's their job, for heaven's sakes. Is, in fact, specifically the San Francisco Fed.
Yeah.
Who is sitting there watching Silicon Valley Bank or Signature or First Republic or any of these things? You look at the metrics that the regulators have, and every single one of those banks passed with flying colors. That days before they went bust, right? And then what happens? They all go bust, and then the Fed comes out with their, was it the Bank Term Funding Program, I think is what it was called, the BTFP. So then they come out with all these measures, all these quote unquote tools, right? Well, if they were that good, then they would have done that 2 weeks before they went bust, not 2 weeks after they went bust. And it's the exact same thing with the economy. They got to wait for the stuff to hit the fan, and then they will come out and respond. But let's keep in mind that when the Fed responded back during we'll call it the cerveza sickness, I know YouTube is touchy on that, but people know what I'm talking about. So in March of 2020, that's when the stuff was hitting the fan big time, right?
Yeah.
And if people remember correctly, the Fed was supposed to meet on a Wednesday. They had an emergency meeting the Sunday prior. They came out and dropped rates down to 0%. They basically announced QE infinity, and they committed up to $1 trillion a day in the repo market. They took everything and just threw it at the problem. And the next day, the stock market was down like 1,500 points. And it kept going down until the government came out and said, hey, we announced this CARES Act. It's going to be government deficit spending. We're going to put money right into the back pocket of the average American. So my point there is that everyone thinks that there's this Fed put. I don't know. We didn't have a Fed put in March of 2020. The market saw what the Fed was doing and basically just gave them the finger. So it all depends on the severity of the crisis, right? If it's just this, if it's like a .com type thing, then sure, I think monetary policy might be able to smooth that out. But if it's a GFC type thing, you're not going to get away with just monetary policy. You're going to have fiscal. And I would argue you're going to have a lot more fiscal than we had last time because of that, the diminishing returns.
Yeah, I know. I fully agree. But speaking of Cerveza, I mean, when we look back at what happened at that era, remember we were seeing everything on TV, and it was like the movie I Am Legend, basically from overseas, right? Like everyone was like, past that everywhere, dead. Then, America, you saw, let's just say not that, right? But yet the same policies were enacted with eviction moratoriums, foreclosure or forbearances, student loans still forgiven at this point until October 1st. Utility bills, all of these different protections for people to not pay bills. They continue to push forward this government dependency, taking universal basic income from 11 pilot programs in 2021 to now 82 across 29 states. So they've increased the UBI pilot programs by 700% in the last 2 years.
And it's not just dependency; it's economic distortions. Mm-hmm. When the government comes in and spends like that, and what happens is the government spending is a larger and larger percentage of overall GDP. So anyone that's gone down to the local DMV knows how efficient the government is, right? So just imagine if the government government spending is a larger and larger percentage of GDP, that by definition means the economy is less and less efficient. And that's those economic distortions that I think may be even more detrimental than the dependency component that you talked about, although they're both really, really bad.
Do you think we could see a situation in which, we're already starting to see it, you mentioned Silicon Valley Bank, you had First Republic, you had Signature, you had PacWest getting acquired by Bank of California, you had all these small little consolidations, and they're now increasing reserve requirements for some of these small banks. I think it was like $63 billion, something like that, where they have to essentially increase the debt load. And as they do that, borrower deposits are shrinking, and they're supposed to run out of money by the end of Q4. And as that's happening, they're continuing to jack rates, diminishing their book. So you start to see this immense pressure on these banks. Do you think we could see a situation where these banks will definitely fail by design, and the ultimate goal will likely be maybe a half a dozen or a dozen banks in which there could be maybe some type of central bank digital currency in which...
Yeah, so the closer you get to one bank, the closer you are to a CBDC by definition.
Yeah.
By design, I don't know. But the one thing that I can tell you definitively is that the global elite, the central planners, the authoritarians, they're never going to let a good crisis go to waste.
Yeah.
That's their MO, right? They're all Machiavellian at the end of the day, as well as Malthusian, which is a great combo, and Marxist. So you've got the three M's there. They're all Marxist, Machiavellian, and Malthusian. So that's their game plan. So, but I think that even if they're not out there pulling the strings, which they very well could be, we're going to have more and more of these crises because they're just happening. The time frame seems to be consolidated.
Yeah.
Now, whether that's because of a fourth turning, whether that's a generational thing, whether it's just the higher dependency or the higher economic distortions created by the government, I don't know why, but my base case would be these crisis type situations are going to become more and more frequent, and that's going to give the central planners the opportunity to come in on their white horse and give us a deal with the devil.
Yeah.
Hey, I'll provide you safety and security, or the illusion of safety. All you have to do is give up your freedom. Yeah. And what we saw in 2020 is an example of how many Americans will give that up without even batting an eye.
Yeah. So they're talking about the same thing that happened in Cerveza 1. They're talking about it now. I'm seeing more headlines and some schools closing and stuff like that. And it makes me really wonder if we're going to start to see a situation that could unfold at the end of the year, maybe in November, December, in which we could potentially walk into another problem, and then they would bring out a solution right at the same time as you're mentioning the reality of the inverted yield curve that would come to fruition. Then they could potentially step in.
Yeah, it's an easy pitch, right?
Yeah.
I mean, you mentioned the CBDC. Most people don't really understand the plumbing, and it's important that they do, because a CBDC is not some sort of Fed coin or some sort of competing currency for the dollar. That's a misconception. All a CBDC is simply your dollar deposits, instead of being a liability of a commercial bank, are now a liability of the Fed. Or even if they were a commercial, it'd be one commercial bank. So, like as an example, Gazbank was the bank that they had in Russia, communist Russia. I believe it was from 1922 to, the fall of the Soviet Union, so maybe 1990, something like that. And what's interesting, if you go back and look at Gazbank, that was the central bank, but that was the commercial bank. That it was just one, and they were one and the same. So what that means is that their banking system was all on one ledger. We had a unified ledger, if you want to use the terminology for from the BIS, right? So you had this one ledger, but if you read what that one ledger allowed them to do, the central planners in Russia, it's literally like reading what we should be concerned with regarding a CBDC. They were spying on everyone because they could see their transactions, even without computers. It was all on one ledger. They could provide credit to those that had political favor.
Yep.
Because
like the ESG scoring. Like,
yeah,
you want to get funding?
If you think about it, all a bank is, all our monetary system is a network of ledgers. That's it. So if you just have one ledger, it's not possible for the bank to go out of business because they never have to transfer an asset.
Right.
So most people, they might not know this, but they would, I think, intuitively believe that the Fed cannot go bust, right? And so they have an accounting gimmick called a deferred asset. But the bottom line is they can have negative equity all day long, and they're still going to be in business. So they can extend credit based on narrative. They don't have to extend it based on merit. They don't have to be paid back because they can't go bust, you see? So why, from a technical standpoint, regarding the plumbing, why can't they go bust? Because they never have to transfer an asset. That's the reason why. Just like Gazbank, there was just one bank, there was just one ledger, so they never had to transfer an asset to another bank. Therefore, by definition, they could not go bust, right? So why is that important? Because I think in this next crisis or this next wave of crises, to your point right now, we can tell that the banking system is relatively unstable. I'm not saying it's this, it's a replay of the GFC or something like that, but you can tell that money and credit is tight. And in an economy that's built on credit, that's not a good thing, right? In a global economy, by the way, that's built on credit and dollar liquidity, if you have that liquidity start to dry up, if you have that credit tighten, most likely you're headed straight for a recession, if not something worse. And that's going to impact the banks, right? So the Fed comes in, let's say we have more of these bank failures. The Fed comes in and says, listen, we want to ensure that depositors never have to take a haircut. Because yes, Janet Yellen came out and promised us that the depositors would have nothing to worry about at Silicon Valley Bank, but we've got 18, 20 trillion in deposits, and the FDIC only has 180 billion. That math don't work. If you've got a lot of these things going bust, that dog don't hunt, right? So in a scenario where more of these regionals went bust, even if the big banks don't have problems, you could see the Fed coming out saying, listen, we've got a solution here, guys. We've been doing it all wrong. Why on earth have your dollars, your assets, been a liability of Wells Fargo, Bank of America, Chase, or whatever commercial bank when there's a possibility that they could go bust? It would be a far better system if everyone's commercial bank deposits, their dollar assets, were just a liability of the Fed. Because we wouldn't even need FDIC. You would never, and then what all these entrepreneurs would do is it would unleash this wave of productivity because no one would ever have to worry about their deposits being safe again. And oh, by the way, we can pay you the exact same interest rate that we pay Jamie Dimon. Because most people realize that they're only getting 300 basis points, if they're lucky, at their local bank for a checking deposit account. And they realize that JP Morgan, I use Jamie Dimon, but I'm using him as a placeholder for JP Morgan, they're getting IOR, which is interest on reserves, because their checking account is with the Fed. So they're sitting there picking up, let's say, 5.5%, while the average Joe is getting 3%. So to me, that sounds like a ripoff.
Yeah.
So think about this. We could move all these commercial deposit liabilities over to the Fed's balance sheet. The depositors would never have to worry about a bank going under again. We'd never have to worry about bank runs. We could eliminate the FDIC. We could take all this pressure off of the taxpayer, by the way, and the Federal Reserve could pay the average Joe the exact same interest rate. John, what's not to like?
Don't they already
What's
have
not to
like Bank of International Settlements has something called Iceberg, right? Which
so that's a trial balloon.
Yeah.
That's a trial program where they're talking about what they call a unified ledger. So this is where all of the ledgers within the domestic economy would be unified to the central bank, exactly what we're talking about. And then the central bank's ledgers would be unified with the Bank of International Settlements, and they would just basically be the puppeteer for the entire global monetary system. That's their idea. That's what they want to achieve, because they're central planners, and obviously that's not going to be good for the average Joe and Jane. But if we go back there, I just want people to realize that what I was just telling you, that was not my idea of what would be great. I'm just giving you the sales pitch
of what
that the Fed, I think, they could easily spin it to where, look, all these benefits that you would have, so why not take the commercial bank liabilities, those dollars, your assets, and move them to the Fed's balance sheet? But what they wouldn't tell you is that once all those dollar liabilities were moved to the Fed's balance sheet, sure, you wouldn't have to worry about taking a haircut, but now all of a sudden, we'd basically have a CBDC because all the data from the transactions would be going to that one ledger, just like they were going to that one ledger in communist Russia with Gazbank.
Yep.
And so all of the things that people worry about with the CBDC, that would unfold right in front of your eyes if we move those deposit liabilities to the Fed, which I think is kind of the direction that they're going to want to go. So people should not be concerned with a Fed coin or some sort of CBDC that competes with the dollar. No. A CBDC is not some other currency. It's simply your dollar assets being a liability of the Fed. And by the way, the good news is right now that's illegal. It's illegal. It's against the Federal Reserve Act for the Fed to have basically retail or non-bank accounts as their liability. That said, they didn't pay any attention to the Federal Reserve Act during 2020. They completely ignored it by setting up special purpose vehicles to buy corporate debt. Now, that's illegal. So I'm not saying that that's a constraint for them, but fortunately that's currently in the books. Another bit of good news is you see all of these politicians come out against CBDC, mostly these right-wing or Republican guys, that they know that that's a real bugaboo. It's really kind of a hot button for a lot of their constituents. So they want to stand up as the guy that's against CBDCs. Now, when you read about how they talk about it, they really don't understand the plumbing too much. But the simple fact that they're talking about it, and you got RFK out there talking about it on the left side, right? This is all very, very good. And I always look at the different brands, right? You look at Coca-Cola as a brand. You look at the United States as a brand. And I think it's great that the CBDC brand itself is becoming so toxic.
Right.
To where even the politicians don't want anything to do with it. So my concern there, though, is that if people don't understand that a CBDC is really just the Fed having your dollar liabilities, that they'll be able to implement this because they won't call it a CBDC.
Yeah.
They won't come out and announce that, hey, we're implementing this CBDC. So they just come out and announce that, oh, by the way, we're doing this for your safety. We're doing this to pay you additional interest rates. And so the Joe public Even the people that are very anti-CBDC, you could see them going along with it because they don't even realize that they're the lamb being led to slaughter unless they understand the back-end plumbing. And that's why I'm so adamant about people kind of getting the getting the plumbing, for lack of a better term, just understanding that it's not a competing currency, that it's just simply those deposit liabilities going to the Fed.
And so once those deposit liabilities are at the Fed, and then they are able to have a better understanding of who you are as an individual and a consumer, then they're then able to say, this could be better for the environment if you ate less meat. This could be better for the environment if you traveled less.
Exactly. That's like I was saying earlier, every single thing that people worry about, a CBDC, social score being one of them, the central planners would then have the power to do it because it's all consolidated onto one ledger. And let me be clear, it doesn't have to be consolidated onto the Fed's ledger. Let's just say that JP Morgan, let's say every bank went bust and JP Morgan was the only one left standing. Well, that's basically the exact same thing because the banking system technically owns the Fed. So if JP Morgan was the last bank standing, they would own all the shares to the Federal Reserve. So that's basically like Gauze Bank.
Yeah.
And you still have that same dynamic where all of the deposit liabilities would be on one ledger, and then JP Morgan couldn't go bust, but then they would have access to the data that they give to the government to issue the social score. So it's not just all of the, it's not just everything being consolidated onto the Fed's ledger, it's any ledger.
Got it. What do you think? What are your thoughts on, I think it was very interesting how in 2020, everything kind of hit the fan. That was the main focus. And then it got pushed towards environment. Everything is about the environment. Everything is about, like at New York, for example, they just said that they're gonna restrict meat consumption. And if you go to c40.org, I don't know if you ever heard of that website.
No.
So essentially it's Michael Bloomberg, it's Hillary, it's Soros, all these people. You have World Bank, basically a lot of authority, a lot of power, a lot of money, a lot of control.
Yeah, it's all these globally. Right? I call them the Malthusian cult.
Yeah, and so what they said is that their goal is to retrofit properties, both residential conversion, industrial, office, everything, to re-retrofit these properties to be more environmentally conscious, right? Mm-hmm. And so it's and they have certain guidelines in which they need to hit by 2025 and 2027 and 2030. Just like in New York, they have Local Law 97. I don't know if you ever heard of that, where these property owners, they have to meet certain guidelines by January 1st, 2024. And if they don't, there's going to be $200 million worth of fines that's going to be sent on these properties. And by 2030, it's going to be over $900 million in fines. So I think it's very interesting to look at the points in which you just made, but also take into consideration that you have the student loan situation that's happening. You have $1.5 trillion that has to get refied in commercial real estate in the next year. Then you have $2.5 trillion that has to get refied by 2027. Most of these properties are underwater. They're going to have a harder time getting loans. Like David Sachs, I don't know if you know who he is from the All In Pod. He's a multi-billionaire. He has a $15 million property in San Francisco, has a $9 million loan on it. It's due to get refied at the end of the year. They were only going to lend him 2.4. Yeah.
I see that. I've got a mastermind group with Kenny McElroy.
Yeah.
And I'm sure your viewers might know him from YouTube. And I hear the exact same thing, even from Kenny, who is top shelf as far as that multifamily space. He's been doing this for decades. So if anyone can get credit, it should be Kenny. And he's same exact thing. Everything he's trying to refi, they're either doing it at a much lower LTV, or they're asking for him to put up like a couple $1 million in an escrow account.
Yep, collateralized.
Yeah.
Yeah, and so they said that we'll give you 2.4 on this $15 million ability, but you have to guarantee it against other assets. That 2.4, not against the actual asset as a whole. Before, if you were buying commercial property, they would fund that deal based on the income of the asset.
Yeah, right.
But now they're looking at it completely differently. So I think it's going to be interesting when we look at this environment which we were in the last couple of years, where everyone was investing in 3, 4, 5 caps. They were pulling out as much cash as possible, and now they're walking into this liquidity crunch at the same time in which these regionals are getting pinched.
Yeah,
and you have all these things happening.
And at the same time, Powell's taking rates to 5.25%.
Yeah,
and you have an increased risk premium, which is what you're talking about there. And how do these people refi? And they got a lower occupancy rate, and the value of their property is half of what it was when they bought it in 2021. They way overpaid. I mean, you're going to have a lot of these properties going back to the banks. That's the bottom line.
Yeah. So what do you?
And that's going to tighten liquidity even further.
Do you think we're like how do you see this? BlackRock came out recently, about 2 months ago, and said that they're going to start buying out residential and commercial loans from these struggling regional banks on these assets, right? And you have like Barry Starlight from Starwood Group. They own like 180,000 rentals. He's raising a big fund to buy distress. You have Blackstone just raised $30 billion, $400 million to pick up single-family rentals, logistics, and data centers. Because you have all this cash and capital just sitting on the sidelines. It's like when people...
Yeah, but take that to its logical conclusion. What's the end game there? The end game is everyone goes bust and every single asset moves onto the Fed's balance sheet.
Yeah.
That's what we're talking about.
Yep.
Because, so, you know, you talk about all these big funds, right? And so what we've done is, let's say, not everything, but most of the real estate market, let's say, was relatively decentralized prior to the GFC.
Yeah.
Then you have the GFC, the crisis, and what happens? All the BlackRocks, all these funds come in and buy all of these properties. So now they're the landlords. So you get all of the real estate being more consolidated. Okay, well, now it happens during COVID, the exact same thing, but to a greater degree. And then what you're talking about, and let's say this next crisis, you've got the BlackRocks, instead of having multiple, let's say, private equity firms, now the only one left standing is BlackRock. They're the only one with access to liquidity because they've got all the political connections and whatnot. And so then they come in and they suck up all the housing, and I'm taking it to an extreme just for the sake of the example, and they suck up all of the housing units, let's say. But then I think we go into a crisis, maybe in 2028 or something like that. Who knows what happens? But then BlackRock goes bust. So then the only, balance sheet left standing is the Federal Reserve. And of course, since we're in this mode right now where we can't let anyone go bust, it's like the participation trophy economy, right? No one can feel any pain. No one can go bust. And therefore, if BlackRock owns all these assets, they go bust. Well, there's only one balance sheet left. It all goes onto the Fed. And that's where you could get into that situation that Klaus always talks about, where you'll own nothing and you'll be happy.
Yeah, because they're pushing something right now. Biden's saying that he wants all Fannie Freddie debt to be controlled under essentially a national rent control, in which they will be able to define what they call an egregious rent hike.
Yeah, right.
So it's very interesting to look at that. And then he has something else called the Renters Bill of Rights. I don't know if you heard of this, but essentially allows tenants to organize and strike as if it's a business. They can organize and strike. They can get free legal counsel, and they have all these new found rights as tenants. Yeah. And so I feel like there's going to be a huge opportunity to reassess risk and make a lot of money in the coming couple of years. But I think the next 6 months are going to be really, really interesting.
Yeah, it's like everything else. The larger the crisis, the larger the opportunity.
Yeah.
So a lot of people on my channel, they go, "Oh, you're a perma bear" or something like this, and I have a couple rebuttals to that. But first and foremost is, listen, I have no bias on the bearish side. I'm just looking at the data.
Yeah.
And I'm just telling you what the data tells me. And I have no, it doesn't help me in any way for me to be bearish. And I'm not always bearish, because if you go back and watch some of my videos from March of 2020, I was like, hey, things got cheap.
Yeah.
Let's go. Woohoo. Let's back up the truck on some of these stocks, which is, I don't give investment advice, but I was just telling people what I was doing for my own portfolio. Yeah. And that's exactly what I was doing. Now that stuff is cheap, now I'm a bull all of a sudden. It's just over the last few years, there's been, from a fundamental standpoint, things have gotten way, way out of hand. So that's why I'm going to be mostly bearish. But and then the other thing that I would say is, look, if you turn on CNBC, if you listen to Powell, if you listen to Bloomberg, financial media, mainstream financial media, you're going to hear nothing but rainbows, sunshine, unicorns, all these things. And that's unfortunately the only thing that most people listen to. So if I can go out there and tell you, hey, maybe I can show you the other side of the coin, and then you'll be able to come to your own conclusions with much more balanced data. And so I think those are kind of two of the hopefully of the value propositions for my channel, and why someone would watch it. But I think the overall point here is, if you're watching my channel or your channel, something like that, I'm sure people have said, man, there's a lot of reasons to be bearish. I totally get what you're saying about the inversion of the curve. Now is the time to sit back and just wait for things to play out, realizing that if you do believe that we're going to have a recession, a hard landing, that is going to provide you a fantastic buying opportunity. Now, I don't know where that buying opportunity is going to be. It might be in real estate. It might be in commodities. It might be in something very esoteric. It might be in AI. Who knows? That bubble can completely crack. It could be in marijuana. That industry has gotten just decimated, just completely wrecked.
Yeah.
And remember, a couple years ago,
Everybody was investing.
everybody was talking about it. Everyone's talking about weed getting legalized and it's going to be bigger than alcohol. Blah 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 blah.
Yeah.
How many people are talking about it now?
I'm going all in. I'm like, I don't know. I'm not going to touch it.
But now
No one hears
nobody's
it.
talking about it. Nobody. So that could be a huge opportunity. I'm not saying that it is, but I'm just giving you an example. So I think there's a lot from a financial standpoint. Unfortunately for the economy and the average Joe, this is going to be a very, very tough, turbulent time. I think it's going to increase social unrest substantially. That's probably my biggest worry, to be quite frank. I'm much more worried about the social implications of this playing out than the economic implications. But for those people who are prepared, just like the GFC, you're going to be able to take action, and you're going to be able to
back that truck up and make some real money.
you're going to be able to make some real money. Unfortunately, I just hesitate to say that because it's going to be at the expense of so many people that just weren't prepared. Just like we saw during the GFC.
Yeah, I've seen comments like, "Oh, John, all you care about is money," and it is a finance channel. But at the end of the day, if you're not looking at things fundamentally of what's actually really going on and making smart, calculated decisions on what would be best for yourself and your family, and really seeing things for how they are, you're going to do yourself a disservice. Because either you're going to take advantage of an opportunity or someone's going to take advantage of you.
Yeah, I mean, you've got to take a tactical, unemotional approach to this, because you've really got two options. Either you can just bury your head in the sand, get emotional about it, and you're going to become a victim.
Yeah.
So either become a victim or try to prepare. Those are your only two options. And prepare by taking a calculated approach to this. Yeah. And although it seems callous, I would rather be in that group that's in the latter.
Well, that's what they want. They want a society of victims. So, yeah, I agree with you. What are your thoughts on Bitcoin?
So I think everyone should own Bitcoin, but not because it's going to 1 million or because it's going to overtake the dollar or become the world reserve currency. It could, but I think you've got to look at I think you've got to put Bitcoin in certain buckets and then assess the probability of each bucket individually, right? So if we put Bitcoin for a moment in the global reserve currency bucket, I would say the probability is not zero, but it's very, very low, especially in the next, call it 10 to 15 years. If you put it in the now if we're looking at it in the bucket of going to 100,000, okay, I can see that happening. Probability, not 100%, but it's a lot higher than it becoming the global reserve currency.
Yeah.
Then when we put it in the next bucket, which is why I like Bitcoin, it's having purchasing power outside of the system. And for that, you're almost guaranteed that, unless it goes to zero or something like that, you're guaranteed to have that purchasing power outside the system. So let's rewind a little bit. And as far as the CBDC, I think that's not a matter of if, but a matter of when. So then what you've got to do is say, okay, how am I going to navigate that type of world, assuming that it's coming within the next 5 years or so? Unfortunately, I don't think anybody is going to be able to live outside of the system completely and maintain their standard of living. You've got a lot of the people in the Bitcoin space or in the gold space saying, okay, fine, bring on a CBDC. I don't care. I'm just going to transact in gold.
Yeah.
Or good luck with that. Sure, you might be able to find some people that you're able to barter with and they'll take gold coins, but you're not going to be able to pay your health insurance with that. You're not going to be able to buy a plane ticket on
Showing
Delta
up to
or
with some junk silver.
It's just not going to happen. Now it may over long, Bitcoin, maybe in 10, 15 years we get there. But even, my good friend Lynn Alden is one of the best in the space. And I've had this conversation with her multiple times. And even she, because you've got a big problem there with the volatility component. And sure, it may be solved, but that's a long time off in the right. We're talking about 10, 15 years where I think we'll get a CBDC a lot sooner than that. So I think you have to come to the conclusion that you're going to have to operate to a certain degree within this system. So how do you minimize your exposure to it? You're going to have a bank account that's a CBDC, because most people have a job, they have a paycheck, they have to pay rent, they have to do these things that require you to have a bank account. It is what it is. So, and those dollars that you're going to be earning most likely will be in your bank account, which will be a liability of the Fed, and they'll be able to track absolutely everything. So go ahead and pay all, take your income, your paycheck, deposit it there. Go ahead and pay what you have to, your rent, all these things that the government probably won't really care one way or the other. But then if you've got purchasing power left over at the end of the month, that's when I think you take it out and buy Bitcoin or you buy gold to have that outside of the system. Now you could say, George, well, they'll ban that. Well, maybe not. This particular scenario assumes that they're not going to ban that. So they allow you to buy the Bitcoin. So now you've got purchasing power completely outside of the system. And then if you have to go and transact in something that might not be appropriate, you get your monthly ration for diesel fuel, let's say, and you've got to go buy some more. Well, then you can take some of your Bitcoin or some of your gold and you can get cash. You can get currency for it. And then you can transact in currency to as much as you possibly can. And that allows you to maybe have a better social score than you otherwise would. I also think there's going to be massive differences between states. I see a social score very similar to the, we'll call it the medicine card that you had to have. So if you had that medicine card to prove that you'd taken the medicine, in Texas, that was, who cares? Because no one's ever going to ask for that, so it didn't even matter. In New York, that was a big deal.
Yeah.
You had to have that. So my point is, in the future, I think that everyone is going to have a social score. They might not call it this. It's going to be a de facto social score. But if you live in Texas, it's not even going to matter because no one's going to pay any attention to it. Where if you live in New York, it's really, really going to matter. And therefore, if you're someone that values your privacy, freedom, and liberty, I would start gravitating towards those states that most likely won't pay any attention to it, just like they didn't pay any attention to that card during 2020 and 2021. So I think that's the way. And you say, well, George, what if they ban cash? Yeah, they likely will try. I think that's going to be a lot harder for them, although not impossible. And that's when I always start talking about a plan B. So I realize that this isn't realistic for every single American, but especially nowadays with so many people working on Zoom and working online, I think it's more realistic for a large percentage of Americans, where even prior to 2020, it was not an option, because everyone was just working in their brick and mortar office. So now you can look around and where we are in Colombia, as an example. I don't know what percentage of transactions are settled in cash, but it's a large
So last night I went out, we went to get some food, did a bunch of things. No one took card. I was like, nobody. We had to go to an ATM. Every single thing was cash.
I'll tell you another story like that. We were talking about your cameras here, these Sony, I think they're 4K cameras. I've got one in my office and I wanted another one. And I just happened to find one at the local mall. Now this is not some seedy area. This is that Santa Fe.
It's a beautiful mall. We walked by.
Yeah, in fact, that's where we had lunch a while back. So this is just as nice, if not nicer, than any high-end mall that you'd see in the United States.
Definitely.
And there was a camera store in there, totally legit. They're not selling like Chinese knockoffs and stuff like that. Totally legit. And I went in there to buy one of these cameras, and it was like, you'd probably know better than I, but it was like $2,000.
Yeah.
Right? Like $2,000, $2,500, something like that. And I went in there and I had my Banco Colombia card, right? I'm like, I'd like to buy this camera. I forgot what it was in pesos,
I think you said it was like 10 million or something.
Yeah, like 10 million pesos or something like that, which is about $2,500. And they said, oh no, we don't take card. I'm like, what? It's like, no, just cash only. I'm like, cash? Like, do you really expect someone just randomly in the mall
Come
to
with
be
a
walking
non-cash
around with
like that,
10 million pesos in their back pocket?
Yeah.
Of course, it's insane. But that just goes to show you. Another quick fun story is, like I said, this is one of my rental properties, and I've actually been living here for the past year. I've tried to rent a house up on the hill there, and we're really close to getting a deal done. But with one of the properties that I looked at, they were asking about it was about $10,000 a month for rent for this place, but the only way they would do the deal, cash.
So the landlord
Literally
knocks on the door to
cash.
give them 10
I'm not
grand?
talking about like a money order
Yeah.
or some sort of cashier's check. I'm talking about you bring them a shoebox every single
On the
month.
first of the month.
That's right. With literally, what was it, 40 million pesos?
Yeah.
40 million pesos was about 10 grand.
Yeah.
And every single month you go out and you just drop it off with his accountant, and that's how they wanted to be paid.
Yeah.
So my point there is that if you're setting up a plan B and you value privacy and freedom and liberty and want to navigate outside of that system as much as possible, start looking for a plan B in countries where a much larger percentage of settlement is done with just cold hard currency, because it doesn't preclude them from having a CBDC in the future. That's not what I'm saying. But at least you've got a longer runway,
yeah.
and you can buy time, maybe for Bitcoin, to start to build up an ecosystem around Bitcoin that's large enough to where you could start transacting in Bitcoin almost exclusively without having to lower your standard of living.
How much does it cost to live in Medellin if you're living slightly above the average? Like if you were to live a normal American lifestyle, 1-bedroom apartment, nice area,
I mean,
couple grand a month.
oh yeah, it's ridiculously cheap. I mean, I'm trying to give you some specific examples, but if you had $2,000 or even $3,000 a month, you'd be living like a king down here. I would say that would be the equivalent as far as just your standard of living. If you were making $3,000 a month down here, that would be the equivalent of maybe making probably, I'd say 12 grand a month back home.
Wow.
Something like that.
Yeah. Well, it's been really great connecting with you. I enjoyed the conversation, learned a lot, and
Yeah.
check him out. I'm going to leave all of his links down below in the description, and see you guys in the next video.